Over $1 trillion vanished overnight, and no one in Washington saw it coming. China didn't just freeze investments into the U.S., it cut off the money lifeline to Wall Street, tech, and manufacturing in one quiet move. No speech, no warning, just financial silence. Now American companies are scrambling and global trust in the dollar is cracking. But what if this isn't a freeze? What if it's a trap? This wasn't panic, it was a chess move. In February 2025, China quietly reclassified the U.S. as a hostile jurisdiction, part of new outbound investment rules targeting risky countries. Just weeks later, on March 17, 2025, the State Administration of Foreign Exchange issued a covert order halting all outbound investment into U.S. firms for geopolitical risk and asset security. No press conference, just a buried memo. The strategy: to shrink U.S. financial leverage over China without firing a single shot. Chinese economist Zhao Ziyang recently warned, capital flows are the new weapons of influence. Withdrawing dollars lowers Washington's economic punch while building Beijing's bargaining power. This move isn't about trade or tariffs, it's a strategic financial repositioning designed to reshape global influence. China is pulling money from the U.S., but pumping capital into ASEAN neighbors and digital yuan infrastructure. Instead of waging a trade war, China is engineering a capital war, and the freeze on U.S. investment was just the opening strike. The freeze didn't just hit headlines, it hit wallets. Since 2016, Chinese investment in U.S. companies plunged over 95%, tumbling from $46 billion to just $2.3 billion. And now, since March 17, 2025 freeze, it's officially zero. Wall Street is reeling. In Boston, Hartwell Tech saw a $180 million funding deal collapse overnight after Chinese backers pulled out, forcing them into emergency borrowing at 11.3% interest against IP and property. That's not just costly, it's survival mode. As banks tighten, companies are turning to risky debt. In 2024, over $430 billion in junk bonds were issued, nearly double previous years. Fitch Ratings warns that 1 in 5 mid-sized U.S. firms could struggle to refinance by late 2025. No funding means frozen hiring, delayed projects, and higher prices. What began in boardrooms is now seeping onto Main Street. The capital collapse has shifted from spreadsheet stories to neighborhood realities, and it's just getting started. America's big plan to bring factories home is now running into a wall, called money. After Trump signed an executive order in 2025 to expand reshoring tax credits, hundreds of U.S. companies rushed to announce new projects. But now over 62% of them face major funding gaps, according to the National Association of Manufacturers. Why? Because many of those plans relied on foreign capital, especially from China and Taiwan. With Beijing freezing all investment, that pipeline is gone. The impact is real. A planned $8 billion battery factory in Michigan, backed by partial Chinese funding, is now paused indefinitely. A $3.1 billion robotics hub in Nevada has been scrapped. Even Intel's $20 billion chip plant in Ohio, once seen as the crown jewel of U.S. tech reshoring, just halted Phase 2 construction due to funding delays. The CHIPS Act promised a tech revival, but without capital, it's stuck. As economist Eswar Prasad told Bloomberg, these projects risk becoming symbolic instead of transformative. Building factories is expensive. Without global money, America's reshoring dream is turning into a stalled blueprint. And time is running out before the next recession hits. What started as a freeze on foreign investment is now hitting everyday Americans where it hurts most: their wallets. After Trump's 2025 executive order expanded tariffs on over $500 billion in Chinese imports, prices began climbing fast. According to the Peterson Institute for International Economics, the average tariff rate has jumped to 22%, the highest in decades. That's hitting consumer goods hard. The Bureau of Labor Statistics reports that appliance prices rose 16.7% year over year by the first quarter of 2025. Items like refrigerators, washers, and electronics now cost hundreds more. Major retailers are sounding the alarm. Both Walmart and Target issued earnings warnings blaming shrinking margins on direct tariff exposure. And it's not just big stores, small businesses too are being forced to raise prices or cut inventory. The National Retail Federation estimates the average American household will pay $1,950 more for basic goods by the end of this year. At the same time, wages remain flat and inflation is still stuck above 3.6%, making it harder for families to keep up. With companies passing costs to consumers and no clear relief in sight, inflation is no longer just an economic trend. It's becoming a daily struggle for millions. China didn't just stop sending money to the U.S. It started sending it somewhere else, and fast. After the freeze in March 2025, Beijing began quietly redirecting billions toward friendlier regions, including ASEAN, Europe, and the Middle East. According to a leaked HSBC report, China's sovereign wealth fund boosted its investment in ASEAN debt by $19.4 billion, giving a clear signal the East is rising. In the same quarter, the European Chamber of Commerce in China reported a 19% increase in European capital flowing into Chinese industrial zones. French Economy Minister Bruno Le Maire recently signed a major LNG deal with China, denominated entirely in digital yuan, skipping the US dollar. At the same time, Saudi Arabia, once a solid US partner, is now pulling back from U.S. treasuries and helping launch a $27 billion AI fund with China and Singapore. And Germany's BASF has doubled down on its $10 billion expansion in China following high-level meetings in Beijing. China's real power move isn't tariffs, it's money. In April 2025, the People's Bank of China integrated the digital yuan into cross-border systems like SWIFT Lite and CEIPS, now active in over 30 countries including Thailand, UAE, and Brazil. That means global trade can happen without touching US dollars. In just the first quarter of 2025, Chinese regulators approved 38 new foreign IPOs in Shanghai and Shenzhen, a 52% surge from the previous quarter. This rise in listings shows growing global trust in China's markets and its digital currency. Countries like Brazil, UAE, and Indonesia are already testing ECNY in energy and commodities deals, not for symbolism but for real transactions. China isn't replacing the dollar, it's making the dollar replaceable. This shift isn't sudden, but it is strategic. Instead of bombing dollar dominance, China is quietly offering an alternative, one nation at a time. If the digital yuan spreads, the dollar won't crash. It may just stop being the only game in town. And Washington might wake up to that too late. The most dangerous part of this financial storm isn't what China already did, it's what other nations might do next. For over 75 years, the US dollar has been the beating heart of global trade, powering nearly 90% of all international transactions. But now, for the first time in decades, that dominance is quietly starting to crack. Countries that once depended on the dollar are looking for new ways to trade, ways that don't tie them to Washington's decisions. In February 2025, German Chancellor Friedrich Merz visited Beijing. Days later, BASF, Germany's largest chemical company, confirmed it would double its $10 billion investment in China, despite growing tensions between the West and Beijing. This wasn't just about profit, it was about realigning trust. Even more symbolic was France's LNG deal signed the same month. The long-term energy agreement with China was priced entirely in digital yuan, not dollars. That may sound technical, but in global finance, it's a seismic shift. As former IMF chief economist Kenneth Rogoff warned, the U.S. isn't losing power overnight, but it's losing gravitational pull. That pull is what kept countries buying U.S. treasuries, trading in U.S. banks, and following American rules. But not anymore. In March 2025, Saudi Arabia, America's oldest oil partner, announced a $27 billion joint AI fund, not with the U.S., but with China and Singapore. That fund is being used to back next-generation tech development without touching U.S. capital markets. Meanwhile, reports show more than 40 central banks are exploring ways to settle trade in local currencies or digital alternatives, reducing reliance on the dollar entirely. This isn't just economic theory, it's a realignment of the global financial system. If the dollar is no longer seen as neutral or stable, countries will gradually stop using it. Not in protest, but out of protection. Not in anger, but out of strategy. And if that happens, the U.S. won't need to be attacked to lose power. It will simply be ignored. That's the true final blow. A world where America doesn't get cut off from the system. The system just moves on without it. Quietly, permanently, irreversibly. China's investment freeze may be the first move in a much bigger game, one that could reshape global power and leave the U.S. behind. Subscribe now to stay ahead of the storm, like the video, and share your thoughts below.